The Black-Scholes model, a cornerstone of modern finance, assumes that asset prices follow a log-normal distribution. This assumption is demonstrably wrong, yet this flawed model still prices trillions of dollars in options. How can a model with such a fundamental flaw remain so pervasive? At the heart of the Black-Scholes model is a seemingly innocent assumption: asset prices follow a geometric Brownian motion. This means that returns are normally distributed, and prices themselves are log-normally distributed. Three implications follow. First, prices can never go negative, which matches reality. Second, the variance of returns grows linearly with time, which roughly holds. Third, extreme events are incredibly rare. That third point is where the model breaks down. In reality, financial markets exhibit fat tails, meaning that extreme moves occur far more frequently than the normal distribution would predict. This discrepancy is not just a theoretical curiosity, it has profound implications for risk management and option pricing. The model's failure to capture these fat tails is a fundamental flaw that cannot be ignored. The log-normal assumption is expressed mathematically as ds equals mu s dt plus sigma s dw. Here, s is the asset price, mu is the drift, sigma is volatility, and dw is a random shock. The key is that volatility scales with the price level, so percentage returns are what matter. This formulation ensures prices stay positive, but it also implies that large moves are exponentially unlikely. The model assumes that the logarithm of the price follows a normal distribution, which means that the price itself is log-normally distributed. While this ensures positivity, it also imposes a specific shape on the distribution of returns. The tails of this distribution are thin, meaning that extreme events are considered virtually impossible. However, real markets show that such events happen with surprising regularity, challenging the very foundation of the model. Real-world returns have fat tails. Under a normal distribution, a daily move beyond 4 standard deviations should occur once every 126 years. In reality, such moves happen every 1 to 2 years. The 1987 Black Monday crash was a 22.6 standard deviation event. According to the normal distribution, that should not happen in the lifetime of the universe. Yet it did. This stark contrast between theory and reality highlights the inadequacy of the normal distribution in capturing the true nature of financial returns. The frequency of extreme events in real markets is far higher than what the log-normal model predicts, leading to significant mispricing of options and underestimation of risk. Understanding this fat-tailed behavior is crucial for anyone involved in financial markets, as it directly impacts investment strategies and risk management practices. To quantify the rarity of extreme events under the normal distribution, we use the standard normal distribution. The probability of a return beyond 4 standard deviations is about 0.003%. That translates to once every 126 years if returns were truly normal. But observed markets show such moves far more often, proving the distribution is not normal. For instance, a move of 5 standard deviations would be even rarer, with a probability of less than 0.00006%, corresponding to once every 1.3 million years. Yet, such moves have been observed multiple times in recent history. This empirical evidence strongly suggests that the assumption of normality is flawed. The actual distribution of returns has heavier tails, meaning that extreme events are more likely than the normal distribution would suggest. This has profound implications for risk assessment and option pricing, as it implies that the model underestimates the probability of large market moves. Given its flaws, why does Black-Scholes still dominate? The answer lies in how the market adapts. Traders don't use the model to predict the future, they use it as a common language. By adjusting the implied volatility for each strike and expiration, they create a volatility surface. This surface, often shaped like a smile, corrects the model's shortcomings. In essence, the model is wrong, but it's consistently wrong. This consistency allows market participants to communicate prices and hedge risks in a standardized way. The model serves as a benchmark, and deviations from it are captured in the implied volatility. This pragmatic approach means that even though the model's assumptions are incorrect, it remains a useful tool for pricing and trading options. The market's ability to adapt and correct for the model's flaws is a testament to its resilience and ingenuity. The volatility smile is a plot of implied volatility against strike price. In a perfect Black-Scholes world, this line would be flat. In reality, it curves upward at both ends, reflecting that out-of-the-money options are more expensive than the model predicts. This smile is the market's way of saying, extreme moves are more likely than you think. The smile indicates that the implied distribution of returns has fatter tails than the log-normal distribution. For example, deep out-of-the-money puts and calls have higher implied volatilities, suggesting that the market assigns a higher probability to large price movements. This pattern is particularly pronounced in equity markets, where the smile is often skewed, with lower strike prices showing higher implied volatilities. The volatility smile is a clear empirical rejection of the log-normal assumption and a practical adjustment made by market participants to account for tail risk. Let's compare the model's predictions with what actually happens. The model assumes log-normal returns, meaning extreme events are virtually impossible. Reality shows fat tails, with crashes happening far more often. The model assumes constant volatility, but the volatility smile proves it varies. The model assumes a flat smile, but markets exhibit a skewed smile, especially for equities. For instance, the implied volatility for out-of-the-money puts is typically higher than for out-of-the-money calls, reflecting the market's fear of downside moves. This skew is not captured by the Black-Scholes model, which assumes a symmetric distribution. The discrepancies between the model and reality are not minor, they are significant and persistent. These differences have led to the development of more sophisticated models, such as stochastic volatility models, but the Black-Scholes model remains the standard due to its simplicity and tractability. To see the current market context, look at the VIX, the market's fear gauge. As of mid-August 2026, the VIX sits at 14.25, near its 60-day low. It has fallen 23.6% over the past month. Low volatility might feel comfortable, but history shows that calm periods often precede sharp moves. The fat tails we discussed are always lurking. For example, in the years leading up to the 2008 financial crisis, the VIX was relatively low, yet the market experienced a massive crash. Similarly, the dot-com bubble saw low volatility before the burst. These historical precedents suggest that complacency can be dangerous. The current low VIX may indicate that investors are underestimating the risk of extreme events, which could lead to significant losses if a tail event occurs. Understanding the dynamics of volatility and its tendency to spike is crucial for risk management. Here are the key numbers for the VIX as of August 14, 2026. The index is at 14.25, down 23.6% over the past month. It's 38.95% below its 60-day high of 23.34. The RSI is 31.4, indicating oversold conditions. These metrics suggest the market is complacent, but the log-normal model would say the same thing, and we know how that ends. The RSI at 31.4 is below the typical oversold threshold of 30, but it is close, indicating that the market may be due for a rebound or a further decline. The significant drop from the 60-day high suggests that volatility has been compressed, which could lead to a sharp move in either direction. The low VIX and oversold RSI are often seen as contrarian indicators, suggesting that a period of high volatility may be imminent. This aligns with the fat-tailed nature of returns, where calm periods are often followed by turbulent ones. Here's the deep paradox of financial engineering. A model can be wrong, but if everyone uses the same wrong model, markets can still function. The Black-Scholes model is like a shared language that allows buyers and sellers to communicate. The volatility smile is the market's way of correcting the model's errors. In the end, consistency matters more than correctness. This paradox is not unique to finance, it is a common theme in many fields where models are used as approximations of reality. The key is that the model provides a common framework for pricing and hedging, even if it is not perfectly accurate. The market's ability to adapt and correct for the model's flaws is a testament to its resilience and ingenuity. The consistency of the model allows for liquidity and efficiency, which are essential for the functioning of financial markets. Without this consistency, markets would be chaotic and inefficient. The log-normal assumption is a convenient fiction. It fails to capture fat tails, yet it underpins the options market. The market's answer is the volatility smile, a pragmatic adjustment that keeps the system running. This reveals a broader truth: in finance, consistency often trumps correctness. The Black-Scholes model, despite its flaws, remains a fundamental tool in options trading. Its persistence is a testament to the power of standardization and the market's ability to adapt. The Volatility Smile is a clear example of how market participants correct for model deficiencies, incorporating real-world observations into their pricing. This pragmatic approach is essential for managing risk and ensuring market stability. As we have seen, the model's assumptions are not accurate, but its role as a common language is invaluable. Understanding this paradox is crucial for anyone involved in financial markets, as it highlights the importance of both theoretical models and practical adjustments. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.